Hi, it's Liana Baker, U.S. Deals Team Leader at Bloomberg. I'm back with our first panel discussion of the day. Please join me in welcoming three major deal makers who will talk to us about how to do a mega deal. Here with me is Marc Brown, partner and head of EQT Growth at the private equity firm EQT Partners. Before he joined last fall, he was a longtime deal maker at Microsoft. He worked there for 20 years and led more than 185 acquisitions. We also have Michal Katz, head of investment and corporate banking at Mizuho Americas. She joins in 2019 from RBC and oversees all banking activity in the Americas, including industry and financial sponsors coverage, debt and equity capital markets, and M&A. And finally, Scott Barshay, chair of the corporate department at the law firm Paul Weiss. He regularly advises on some of the largest deals, including yesterday's multi-billion-dollar take-private of data center company QTS by Blackstone. To get us thinking about all the activity, let's pull up a chart on M&A volumes. Michal, you're the investment banker. It feels like we're on track for a record year in M&A after the strong first quarter of the year. Can you set the stage for what's happening in M&A right now?
Thanks, Liana, and good morning, everyone. So, yeah, we're almost at the halfway mark of 21, and I'd say what a difference a year makes. The pace of M&A activity in the first half of this year really kept pace with the back half of 2020, and it really is the rollout of the vaccine, the fiscal stimulus that's still in the economy, and the opening of the economy really removed a lot of the uncertainty that we saw in the first half of 2020. The chart you showed, year to date, M&A volume stand at around 2.5 trillion globally. The U.S. constitutes about 50% of that. That's 4x for the U.S. from same period a year ago. And this activity is very much supported by the constructive stock markets, the low cost of funding. But I'll tell you that with that comes that return of confidence by decision makers, CEOs, boards, and there's obviously an expectation of a infrastructure spending bill and consumers going back into the economy, which should continue to support a robust and active M&A environment. I would say there are also other factors that we're seeing this year that were, I would say, just more that their first innings at the back half of last year. We're seeing more sponsor-led activity. So year to date, about 35% of M&A volume is sponsor-related. Also, the SPACs that raised funds last year. We have 400 or so odd SPACs that are looking for M&A targets. And so putting all that together, plus I would say just the overall financing environment should continue to support a nice level of activity across the board.
Speaking of sponsor activity, last weekend we saw a mega LBO, one of the biggest of all time, with Medline. What are we seeing in the financing markets, Michal?
So, I'd say that there are abundance of financing options out there for both corporates as well as sponsors. Just talked about the stock market buoyancy, which, markets are at record highs, and just under half of transactions that have gotten announced have been stock only or a combination of stock and cash. In addition to that, you have the non-financial corporates, which are sitting at around, 1.6 trillion or so of cash on their balance sheet. And then we talked about private equity in terms of the LBOs. They have raised mega funds over the past couple of years and are looking to put that dry powder to work. In terms of the financing markets, I mean, they're in full recovery from where we were in the midst of the pandemic, both the loan and the bond markets, which are very much supporting M&A activity for both of those, I would say, acquirers.
Got it. Scott, you work across all sectors of M&A deal making. Which industries are you seeing as being especially busy right now?
So Liana, I guess it's easier to answer the other question, the opposite question, which is what sectors are slow right now, because basically it's busy across the board. Once we got past the middle of last year, tech and healthcare basically were leading the way. and they haven't really faltered. But as Michal was saying, as the vaccines have kicked in, as you see more confidence, basically all the other sectors have caught up or are catching up. So, you see a lot of industrials deals, you see a lot of FIG deals. We're seeing consumer and retail deals, which I don't think we ever thought we'd see outside of distressed, and we're seeing no distressed. So if you want to know what sector is slow, there's no distressed anything going on right now. Again, as Michal said, financing basically is almost free, and so there's a lot of a lot of companies taking advantage of it. And then on the PE side, which is not really a separate sector, but is, but we in the in this business really treat it as a subgroup of M&A deals. It's on fire, and PE shows no signs of slowing down. We're seeing, you brought up Medline. There's a whole bunch of others that have happened over the course of the last few months. I think we see a lot of dry powder that the private equity firms need to put to use, and they're putting that dry powder to use right now. And I 100% agree with Michal. We are not going to see a slowdown unless there's some gigantic change in the macro that none of us right now expect.
One of the largest deals so far this year was AT&T's spin merger of Time Warner with Discovery. That just came a few years after AT&T bought Time Warner for $85 billion. It's sort of an example of M&A not really working out the first time around. Marc, can you talk about how to integrate companies to be successful in a deal long term? I know that's something that you'd been involved in terms of bringing in big companies in the past at Microsoft, and those weren't sold right away.
Right. Yeah, I think the story on the AT&T piece of the deal is still yet to be told. We'll see what happens and what value creation happens with Discovery. I know the AT&T folks would take umbrage at the notion that this was anything but a strategic retreat, or like George Washington. But to the point on integration, which is really the key to really what we're talking about here, and is what I think in technology particularly is the most difficult part, because that's where you're dealing with people. So your resource does walk out of the office every day, or used to anyway. And then also, it is where your returns are primarily driven from, right? It is through the synergies, it is through the long-term synergies that you gain through the combination that you're really trying to use to support the buy case and drive value creation in your firm. That makes it really important, but also very difficult. And what we've ultimately came to is that you needed to be flexible. Flexibility is the key. You cannot have one model. You want to start with a plan. You want to see that plan try to run out. You also need to be flexible and constantly learning. And this goes to the Microsoft growth mindset, because one size does not fit all. So whatever you did on transaction A, it's not guaranteed to be different on transaction B, but likely to be different. And so you can go in with some notion of what worked over here can try to work over there, but you cannot guarantee that, because again, you're dealing with people and you're dealing with an environment that is so dynamic in technology that changes happen so quickly that you better be flexible.
Speaking of large transactions, before you can integrate them, they have to get announced and get to the finish line. So this one is for all of you, starting with Michal. What do you have to do to get a mega deal to the finish line these days?
So, some of the stuff we talked about, the market backdrop and the funding, I think those are just kind of the mechanics. I think at every M&A transactions at its core, you got to have an industrial logic, the reason for doing the transaction. And does the transaction make sense? Does 1 + 1 equal more than 2? Are you share, is there this alignment? Is there a common vision? I would say there are a couple of things that particularly are, I would say, are underrated, is that there's no room for hubris when you're doing a transaction. So whether you think about who's going to be the forward-going CEO, like who's best positioned to lead the combined companies, and when you have a CEO that was successfully taking a company from point A to point B, may not necessarily be the right leader to take or to run a larger conglomerate, so to speak. There's also the decision to buy or to sell can be very emotional. And so recognizing that is important. In terms of actually getting it done, I think familiarity is also something that's kind of underrated. What I mean by that is that companies that have tended to have existing relationships or partnerships, whether it be joint R&D or go-to-market strategies, and there is knowledge of the inner workings and the cultures across organizations, are really important to not just actually getting the deal done, but the integration and the execution of the transaction post-announcement. And then the last thing I would say is, we talked about industrial logic. Marc talked about people being really important. And the one thing is that I would say is you got to think beyond the merger. And I'll make the analogy, which is just like it's really important to be ready for the marriage post the wedding day, it's really important to plan for the pro forma combined new company after the day of announcement. So those are a couple of things that I would highlight.
Thanks, Michal. Scott, do you have any thoughts? What happens if a deal leaks before it's announced?
Yeah, so Michal did a great job on the strategic side of this, right? What do you have, before you decide you want to do a deal, a buy, a sell, an MOE, what do you need to be thinking about? So I'll now take it down to the more mundane, the tactical side of it, of how do you get it done without it resulting in a complete disaster? And so you bring up leaks. It's actually interesting under COVID. I feel like there have been less leaks. There just seemed to be less leakiness, and I'm not sure why COVID would have changed that, but I'm very happy to see it. I mean, the deal I announced yesterday went through right to announcement without a leak, and that was happening less and less. Leaks on mega deals as compared to regular deals can be an absolute disaster. It can throw off the valuations of the companies so that either the acquirer stock price can go down if the market doesn't like the deal. If the acquirer stock price goes up, which happens less commonly because the market loves the deal, then it may feel like they're overpaying because it's a much bigger premium. On the target side, if it's a stock deal and the target stock price goes down, that's a vote of the market against the deal. And all that is happening when the two companies have not had a chance to explain the industrial logic, the strategic rationale that Michal was talking about, and that's a disaster. Plus, when you're on the buy side, that can result in what the buyers would call interlopers and what others might call white knights. It could result in other parties coming in and competing for the deal, and it can result in employees and customers and suppliers going bananas and yelling and screaming. And then I've had a few times politicians come in and say, I'll let that deal go through over my dead body, and that's not good. That's not good either. So the advice I generally give my clients in these situations is twofold. Number one, be totally prepared before you even contact the other side, whether it's a buyer or a seller. Be completely prepared. Have done every bit of work that you can do without reaching out. And then second of all, speed is your friend and time is your enemy. So you want to once you engage, you want to get it done as quickly as possible, because the longer a deal is under discussion, the more likely it is to leak and have all the issues that we just talked about.
Marc, you've been behind the scenes on some of this. Any insights on how you get shareholders on board if it really is a transformational deal?
It's a conversation. and it's part of what Scott referred to as telling the story. And I'll get back to the leak piece of it. If a leak happens, it makes it sort of interrupts your plans of how you were going to tell the story. And in some cases, and Scott, you correct me if I'm wrong, you really can't engage even if it's leaked, which leaves all the uncertainty that Scott sort of referenced in his comment, which makes it even tougher. But whether it's shareholders or, as Scott mentioned, customers, partners, employees on both sides, the communication strategy is critical on big deals and small deals. And anything that disrupts that can be problematic. But being a good storyteller is critical to being able to communicate what, again, is not always the most obvious strategic logic that Michal talked about before, to all the audiences. And an important one is obviously shareholders of both companies. And so it takes upfront planning. It's another one of those things that Scott mentioned you need to have done before you need to do it along the way.
We also
Based on your
story planning it needs to have some planning of the seeds beforehand as well. So whether it be in like your earnings calls or non-deal roadshows or whatever it is, just the intent of trying to do something that's inorganic or strategic. You can't just kind of spring it one day and then expect your shareholders or rating agencies to just be accepting of the story. So without talking about a specific transaction, I do think that telling of a story that Marc was just talking about has to start in prior quarters, just laying out that groundwork as to what's to come when the right transaction comes along.
Yeah, investors don't like surprise parties.
Like surprises.
All great points. I'd love to hear your thoughts, Marc, based on your experiences on what is your take on big tech right now and whether the Apple, Google, Facebooks, and even Microsofts of the world can do sizable transactions without a lot of scrutiny from Washington. Can we see these deals happen?
Well, I think the basic answer is yes. And the regulatory environment has always been part of any calculus of any deal, and most big or small. But particularly on the big transformational things. It's another one of those elements that you have had to think about early in the process. You sit down with folks like Scott and his team and think about what the regulatory environment looks like. And it's not just in DC, it's a global issue now, and particularly in big deals where people have points of presence all over the globe. There's always, and maybe you're referring to now, there's a bit of a more political light shed on tech, and that happens from time to time, and different industries go through that on occasion. But the basic message is the same. Each deal does get reviewed, sort of on its own merits, and you have to be prepared for that process, both in terms of the quantity of information required to convince regulators of the purpose and benefits of the deal, but also the time element that it may take, and both parties need to agree on that element of it, because this is the environment where things can take a little bit longer, which is to the scrutiny point. People are I think, pausing a little bit more before deals can get through the 30-day period and avoid a second request, etc. But in general, I don't see or hear anything where there's an absolute prohibition of tech deals by the companies you mentioned or any others.
While we're on the topic of Washington, there's been some potential tax changes in the works. I want to turn to Scott for a second. Any thoughts on whether potential tax changes under Biden is affecting how buyers and sellers are thinking about deals right now?
Yeah, so I think if you go back to the beginning of the year, there was a strong sense that taxes, including capital gains taxes, were going to go up very significantly, and we had a lot of clients talking to us about should we be selling now? Will they be retroactive? Will those tax changes be retroactive? And there are definitely deals that have happened this year that were affected, that have been, that part of the impetus for the deal was potential tax changes. My sense is that is calming down a little bit, and that there's a little bit less of it. I think, as there's a sense that the tax increases may not be as big, as big as people originally thought they might be. So that's still a TBD. But there's definitely some movement, especially where you have large individual shareholders thinking to themselves, if I'm going to cash out for a big gain, better to do it this year than next year.
Michal, is that what you're seeing too? Do you think there's been deals this year so far motivated by this?
I think folks are definitely thinking about it, but at the end of the day, you need a buyer, you need to have a willing seller, and you need to have an agreement on a deal and valuation. And so there's just so many other factors. I would say that it is certainly one, and there may be an acceleration in I would say in the near term. I would agree on that front.
Got it. Michal, just on that note, I know there's been deals in recent years like SAP buying Qualtrics and then spinning it off into an IPO. I know you like to call it a shrink to grow strategy. Could you tell me what you're seeing in corporate spinoffs? Is that still a trend that we're going to see?
Yeah, so part of shareholder value creation is not necessarily just growing for the sake of growing, just adding on scale. What we're also seeing is companies looking at their portfolio and looking to make sure what's core, what's not core. Can I optimize valuation? Can I actually sell or spin a division and use those proceeds to whether it be pay down debt or acquire a more strategic asset to advance and further the growth strategy? And so that leads to some of the divestitures or spin or RMTs that we have seen. And what that strategy allows a company to do is, one, yes, focus on the core business, but also it does provide that captive asset that was sitting within the bigger platform with an opportunity to redefine itself and to provide its own identity and brand, its own capital, access to capital, I should say, and perhaps re-rate valuation, particularly when you have a faster growing asset sitting within a more mature, slower growing conglomerate. I'll say, in addition to the Qualtrics, which is a great example of Qualtrics now having an opportunity to position itself as a standalone strategic asset, Scott and I had an opportunity over the past couple of years to work with Nuance Communications. And here is a company that tripled its stock price from 2018, from 15 to 45. And during that period of time, had sold off one of its divisions to a private equity firm, had spun off another division into a standalone publicly traded company, and revenues went from $2 billion to $1.5 billion over that period. Yet it had completely re-rated its valuation by 3x, and then this past April had sold to Microsoft at a premium for $20 billion. So here is absolutely a case of a company that shrunk and yet grown both in terms of valuation and shareholder creation, which is what we're really talking about at the end of the day.
You mentioned RMTs, which I think stands for Reverse Morris Trust. Scott, I know you're familiar with these. What are they? Why do we still see big ones every year? And why are they so hard to pull off?
So Reverse Morris Trust is a tax term, and these are very tax intensive. So an RMT is where you have essentially a company that spins off a division or a subsidiary, and then at the next moment in time, that division or subsidiary merges with a existing public company. And the tax issue is the shareholders of the shareholders of the spinning company have to end up with more than 50% of the stock of the combined merged company, the merger of the public company and the division. So these are very hard deals. These are very hard deals to pull off. The stars have to align in terms of market caps and share price, but they're done tax free. So it's essential, in a sense, you can do a divestiture. If you're a big company, you can do a divestiture, but not pay tax on the proceeds. So it's a great deal if you can do it, and that's all the financial and tax engineering, as Michal has been telling us several times now, and she's absolutely right. All that's great, but the industrial logic has to be there. The deal has to make sense. It just can't be financial engineering and tax. So they're very complicated deals. They're fun deals to do because they're divestitures, they're spins, they're public company mergers. There's a lot of good structuring that where you can create a lot of shareholder value, but only if the deal makes sense. And that's why when you don't see them that often, but when you see them, you often see the stock prices of both companies going up, which tells you investors generally like these deals.
And the most recent one we saw was the AT&T Time Warner Discovery spin, so definitely still very relevant. I want to switch gears for a second. Marc, I know you're involved in growth equity right now, which is a really hot area. Tell us exactly what that means and what sort of insights do you have in looking at what companies to invest in, since you've been on the other side with a big acquirer looking at companies to buy?
Yeah, great question on the definition, and it's definitely in the eye of the beholder. It means a little bit different things to everybody. What we think it means is it's really the expansion stage of a company where you're talking about providing capital and other resources to help it continue whatever initial growth it has. So after it reaches their defined product market fit and is going into that next phase of its growth, whether that's new market entry, M&A, or other ways of continuing growth. I wish I had a direct insight into all the different corporates about what needs and things that they would have. It would make my life a lot easier. What we're looking for are just great companies with great management teams, large, attractive market segments that can be, in some cases, disruptive because we're backing the companies that are doing some of the disruption. And then we focus on building those companies and let the exit take care of itself, whether that's IPO or an M&A transaction. Because I think the old adage that most companies are bought, not sold, is really true. And so being heads down about building a great company, a great organization, a great culture, and keeping your focus on that as your North Star, I think, is the ultimate thing. And those are the companies we're looking to back.
You mentioned exits. I can't, do an M&A panel here without mentioning the exit through a SPAC, which seems to be something we're still seeing a lot of. We're even seeing mega deals that are SPACs. There's been a few this year, over 20 billion. Bill Ackman is doing one potentially with Universal Music, which involves a Spark. Could we just go around and just briefly, if each of you could just tell me what you think we're going to see ahead in that SPAC market? Start with Scott.
I think that the SPAC market's has been and will continue to slow down a bit, but it will keep going, and I think you're going to see less of the deals where there's really no cash flow and really no business yet, those companies going public through SPACs. I think you're going to see less of that, and you're going to see a predominance of actually good, strong companies using SPACs to go public.
Michal?
I would say that SPACs are very much a valid alternative investment vehicle. we will continue to see them, but I do think the structures will evolve. And we're already seeing that. We mentioned Ackman and the new acronym, they added an R to a SPAC with a SPARK, which is more of a right to participate in the acquisition as opposed to commit to it. But I will tell you that SPACs are not for every company. It's not for every situation, and it's not for every investor. And so that market is here to stay, but it will continue to evolve.
Marc, I'll give you the last word on this.
Yeah, definitely here to stay. And I definitely see a bifurcation on the sponsor side. There are going to be sponsors who can continue to do even some of the deals that Scott referred to of the no earnings kinds of companies, because I think the sponsor will be the thing that investors, pipe investors, and other investors look to. And then I also agree with Michal, it's not right for every company.